All right, think about the number 5 for a second. If you're looking at a financial transaction number, let's say an invoice amount from a vendor, and that number starts with a 9, there's actually only a 5% chance that it occurred naturally. Just 5%. So what does that mean? Well, if a company is suddenly processing a whole wave of invoices starting with an 8 or a 9, there is a very, very high probability that someone is manually making up those numbers to steal money. Welcome to the invisible psychological footprint of corporate fraud. Hello, and welcome to this explainer. Today, we're putting on our corporate detective hats. We're going to provide a really detailed explanation of the source material, covering the rigorous, step-by-step process that internal auditors use to bust corporate thieves. And to make this super concrete, we're going to apply all of these official investigation guidelines to a specific, hypothetical, real-life example, a vendor fraud scheme. Imagine a rogue employee secretly approving duplicate invoices to a fake company they control. Let's dive right in and uncover exactly how the trap is set. Here's our roadmap for cracking the case today. We'll start with the anatomy of an investigation, then move into uncovering fraud through data, followed by the fraud interrogation, and finally, reporting and resolving fraud. Okay, let's jump straight into part 1, anatomy of an investigation, establishing the groundwork. Now, before any of those thrilling movie-style interrogations happen, management absolutely has to implement strict, legally compliant controls over the investigation itself. If the internal auditor documents that fraud has definitely occurred, senior management has to be informed immediately. Unless, a senior manager is the one actually involved. In that case, it goes straight to the audit committee. Management essentially steers the whole investigation using 5 crucial administrative steps. First, they have to develop clear policies detailing investigator qualifications and employee rights. Second, they must ensure evidence is preserved properly, no tampered files. Then, they dictate exactly how to respond to the results, how to formally report them, and finally, how to handle communications. And that last one is huge. It is vital that internal communications about an ongoing investigation are kept to an absolute minimum, so we don't accidentally tip off our rogue vendor suspect. And this brings us right to our hypothetical vendor fraud scenario. Once the plan is live, the lead investigator starts meticulously gathering evidence, totally under the radar. Everything gets recorded chronologically in a log, and let me tell you, the net they cast is incredibly wide. The auditor isn't just glancing at the fake vendor's invoices. No way. They're pulling IT systems access records to see exactly who's logged and approved the payment. They're checking public property records to see who actually owns the fake business. They are even checking social networking sites. I mean, imagine finding out our suspect is suddenly posting pictures of a brand new sports car they bought with the stolen money. It happens. Which takes us to part 2, uncovering fraud through data, the forensic science. So our rogue employee might think they've perfectly covered their tracks, but the data never lies. Auditors use 4 massive technological hammers to find these anomalies. First up, they use computer-assisted audit techniques, or CATs, to automatically flag things like duplicate vendor payments. Then, they use data analytics to spot weird, unnatural trends over time. Third, they use data query tools, like SQL, to literally search the company's database for known red flags, like, say, a vendor address that perfectly matches an employee's home address. And finally, they use data mining to sift through mountains of data to discover unforeseen correlations that a human could literally never spot on their own. And this brings us right back to our hook from the very beginning, the first digit test. It turns out when humans try to manipulate numbers, like our fraudster inventing fake invoice totals, we are terrible at being random. Naturally occurring transaction numbers start with a 1 about 30% of the time, and those lower numbers, digits 1 through 5, are generally fraud-free 78% of the time. But if actual data analysis shows an unnatural spike in invoices starting with digits 6, 7, 8, or 9, the probability of fraud skyrockets to 22%. To put that into perspective, it's a massive, glaring red flag just waving right there in the auditor's data dashboard. Now, when analyzing all this data, auditors rely on different testing methods. Inference testing is basically just taking a random statistical sample and generalizing it to the whole population. Pretty standard. But ground truth testing, that is highly superior for our auditors. Ground truth testing verifies that fraud exists by comparing the official policy, the theory of how things should work, against actual real-world practice on the ground. It relies on direct observation of hard facts and evidence, not just statistical samples. It proves exactly how the real-world controls were bypassed. And what if the fraudster is trying to be incredibly sneaky and rare with their fake invoices? Well, that's when auditors bring out discovery sampling. Think of this as a highly calibrated mathematical net. It's used specifically when auditors suspect internal controls have been deliberately avoided. They can actually specify the exact mathematical probability of finding at least one of these rare, fraudulent items in a massive pile of data. If that sample comes up completely clean, the auditor can confidently say the occurrence rate is lower than specified.
All right, now we enter part 3, the fraud interrogation, confronting the suspect.
So, the absolutely crucial point here is understanding just how different this is from a normal meeting. In a normal interview, your objective is to gather pertinent facts, right? You don't know the whole story yet. But in a fraud interrogation, the internal auditor has already gathered the pertinent facts. They have the evidence. They aren't looking for new facts. The objective is to use the existing evidence to obtain a confession. The suspect is literally only brought in after most of the relevant evidence has already been secured. But listen, here is a massive, flashing warning sign for any auditor. Under no circumstances should the internal auditor outright accuse the employee of committing a crime just to extract a confession. Why? Because if that accusation ends up being unprovable in court, the entire organization could be exposed to severe legal liability. You have to be incredibly strategic. And here is exactly how they do it. The internal auditor acts like a funnel, guiding the conversation from the general to the highly specific. Early in the interview, they might use a really open question like, describe your role in the vendor approval process. It gets the suspect talking, maybe even lying, putting themselves on the record. Then, as the auditor closes in, they spring a trapped, closed question. Do you personally verify the existence of every vendor who seeks approval? Bam! This locks the suspect into a corner right before the undeniable evidence of the fake vendor is presented. To ensure everything holds up legally, strict physical protocols have to be followed. There must always be 2 people conducting the interview, one to ask the questions and one strictly there to take notes and serve as a witness. The interviewer adopts a calm, non-threatening tone, closely observing the suspect's body language and specific wording choices. And there is one final rule here that feels straight out of a spy movie. Once that interview is over, the employee must never, ever be allowed to return to their normal work area. They are now fully alert to the inquiry, and if they go back to their desk, they will absolutely try to destroy valuable evidence. Which brings us to our final act, Part 4, Reporting and Resolving Fraud, Passing the Verdict. At this stage, a very specific, clever administrative tactic is used to protect the company. The final communication is going to include observations, conclusions, and resolutions. But before it goes out, a draft of the proposed final communication should be submitted directly to legal counsel for review. By actively addressing this highly sensitive report to the lawyers first, the findings are covered and completely protected by attorney-client privilege. Pretty smart, right? Once the report is finalized, management and the board hold the ultimate responsibility for resolving the incident. And that resolution can take a lot of different forms depending on the severity of the vendor fraud. It could be handled quietly by disciplining the employee, requesting voluntary financial restitution, and simply terminating the supplier contracts. Or if the damage is severe, the organization might go all in, filing a civil suit to recover damages, filing an insurance claim, or reporting the entire incident directly to law enforcement to encourage full-blown criminal prosecution. Before we wrap up, we really have to clarify a strict professional boundary. An internal auditor is not a judge or a jury. Management or the board might ask the internal auditor to express an opinion on the internal controls related to the fraud, essentially asking, hey, how did our system fail to catch this fake vendor? And that is entirely acceptable. However, it is fundamentally inappropriate for an internal auditor to express an opinion on the actual culpability or the ultimate legal guilt of the fraud suspect. Their job is the data and the controls. The legal system handles the guilt. And that brings us to our final thought. The main goal of pressure testing fraud controls is to determine if they actually resist the real-world pressure to commit fraud. Think about it. High-pressure work environments, aggressive goals, a lack of experienced personnel, all of these create the perfect breeding ground for a rogue employee to set up a fake vendor. Management does have tools to adjust excessive pressure, like rebalancing workloads or increasing resources. So look at your own organization for a second. Are your controls actually built to withstand the pressure of reality, or are they just waiting to be broken by the next 5% anomaly? Keep asking questions and keep learning.